My name is Stacey Brown. We're going to talk about Barclays annual reports. Barclays is a well-known British bank with a large amount of customers within the UK and internationally. This podcast will break down the main aspects of the annual reports for 2019 and 2018 to provide information on the profitability, liquidity, gearing and investor ratios and an evaluation of ratios. Profitability. Profitability ratios refer to the company's ability to make an adequate profit and return on investment. Profitability ratios are a good way to assess the financial health of an organisation and how well the company manages its assets. Barclays uses an effective business model that allows profitability to remain high. Over the past year, Barclays saw a material improvement to corporate and investment bank profitability. However, Barclays could face a decline in profitability in the future as a result of an unexpected rise in unemployment and/or an increase in interest rates. Furthermore, other issues that could impact profitability for Barclays include lower gross domestic product and substantial changes in asset prices and profitability of industries. This suggests that while the business has increased its profitability since last year, there are external factors that could negatively impact future profitability. Liquidity. Liquidity refers to liquid assets available to an organisation such as cash. Some organisations liquidate their shares due to losing profit without waiting for prices to recover. Like any organisation, Barclays is at risk of not having appropriate liquidity to support its assets. But as liquid assets fluctuate, a small decline does not always mean a change in trend, and liquidity could pick up again at a later stage. Barclays were concerned that leaving the EU would have consequences on their liquid position because of a potential credit rating downgrade and an increase to borrowing costs within the UK. Furthermore, legal proceedings connected with the leaving the EU could result in loss of regulatory licensing and permissions and could lead to sanctions. This could have a negative impact on Barclays' reputation with clients and customers, on investors' confidence, which in turn could affect capital liquidity and funding. Barclays' liquidity pool changed only slightly in 2019 from 2018, which reflects that they have an appropriate approach to liquidity management. Gearing. Gearing is also known as the debt-equity ratio or leverage. The debt for 2019 and the equity included non-controlling interest put the net gearing for that year at a higher ratio than in 2018. Efficiency. Efficiency refers to the difference between what is actually achieved and what could be achieved with some amount of resources such as money, time and labour. The income ratio for Barclays decreased in 2019 from 2018. This means that the efficiency is becoming less, but this is due to the cost efficiencies being particularly offset by planned investment and inflation, as cost efficiencies were used in 2018 to offset operational efficiencies such as digitising the bank. Investor ratios. Investor ratios usually refer to the profit after tax of a business. Investor ratios should be viewed over a period of time using trend analysis in order to make comparisons. The investor ratios show that profit before tax has been increasing at Barclays since 2015, with a huge influx in 2016. There was a slight dip in 2018, but Barclays saw profit before taxes increase by almost £1 billion in 2019. Barclays saw a decrease in their profit before tax in 2015 because of the estimated £1.1 billion spent structural reforms. The reason for profit went back up in 2016 was that after the slump in 2015, Barclays decided to simplify their business model and cut dividends, meaning less payments to shareholders. As a result of these changes, profit before tax almost tripled in 2016. In 2018, profits slightly reduced again because of the uncertainty with Brexit. All the performance ratios at Barclays have increased in 2019 from 2018. This includes return on investments, return on capital employed, gross profit margin and operating profit margin. This shows that the bank is performing well. The liquidity ratios are also performing well where they could be calculated, but not all parts of liquidity ratios could be assessed because Barclays do not have stock, sales, trade creditors or trade debtors. Overall, the liquidity ratios show that they were not losing profit in 2019. The gearing ratio has down since 2018, meaning that there is less debt in the company. Limitations. Although ratio analysis is a popular method of financial analysis, there are limitations of ratio analysis. The first limitation is that the information used in the analysis is based on historical information, meaning this analysis does not accurately predict the future finances of the company. Another limitation is that financial statements are released at certain times, so changes are not monitored in between these releases. Limitations that Barclays have experienced in changes to operational costs or expenses. This changes the ratios, making comparison between previous years inaccurate and possibly misleading. Another limitation, seasonal effects and differences in ratios at different times of the year. Although Barclays release annual report, they do monitor their finances quarterly, which keeps seasonality in mind. Recommendations. Based on the analysis above, there are several recommendations to improve the financial management of Barclays. Number 1, monitor their financial position because the financial situation is constantly changing. Barclays need to monitor finances on a daily basis. They also need to review their position against their own set targets. Number 2, because the financial climate is struggling, all businesses need to consider the cost efficiency. Barclays therefore should look into cutting costs in their office by looking energy office efficient, lighting, heating and air conditioning. Number 3, tackle problems when they arise to minimise the impact of negative external factors. Number 4, continue with its existing model as they are continuously increasing profit and reducing their debt. To conclude, this podcast has pointed out that changes to the global economy, unemployment and a movement away from the European Union have put pressure on Barclays. The Barclays business model allows profitability and cost efficiency to be sustainable, with potential to increase, but lower gross domestic product could have a negative impact on the future profitability of the banking group. The liquidity at Barclays could be affected by leaving the EU due to increased borrowing costs and changes in regulatory licenses and permissions. However, in 2018 and 2019, liquidity remained above targets. The gearing ratios have decreased in recent years, which indicates a lower efficiency rate in recent years. However, profit before taxes increased by almost 1 billion in 2019 from the previous year, showing a high investor ratio. Overall, Barclays should continue with a successful business model.